It's easy to assume that smart investors always make smart decisions. After all, they have the knowledge, tools, and resources to navigate the financial landscape with confidence, right? Unfortunately, even the brightest minds in the investing world can, and do, make mistakes. The truth is that intelligence and success in other areas of life don't guarantee flawless investment strategies. From emotional biases and cognitive errors to behavioral finance missteps, many seasoned investors face pitfalls that often derail their financial plans. This video will explore how even intelligent investors can fall prey to common mistakes and offer actionable solutions to help avoid these traps. Intelligent investor pitfalls. Even the most seasoned investors aren't immune to making investment decisions driven by emotion or overconfidence. Many factors can cause an investor to make poor choices, even when armed with financial acumen. Consider the rise and fall of Bitcoin. From its early days of skepticism to its meteoric rise in value, Bitcoin captivated investors worldwide. Even highly knowledgeable investors jumped on the cryptocurrency bandwagon. In 2017, Bitcoin's value soared to nearly $20,000 before crashing to under $4,000 a year later. Many intelligent investors who bought at the height of the bubble lost significant amounts of money. The lesson here? Intelligence doesn't shield you from emotional decision-making. The fear of missing out, also called FOMO, is a powerful driver, and it can lead even the most well-informed individuals to chase speculative assets. Another example is stock market investing. Overconfidence is a common cognitive bias that causes investors to overestimate their abilities or the accuracy of their predictions. A classic example is the collapse of Enron in 2001. Many investors, including hedge fund managers and financial analysts, believed they had insider knowledge or a better grasp of Enron's business model than others, only to suffer massive losses when the company's fraudulent accounting practices were revealed. The Enron debacle highlights a significant problem. Investors often believe that they can beat the market, but they fail to account for unseen risks or external factors that can dramatically impact their portfolio. Behavioral finance. The role of emotions and biases. Behavioral finance, a field that examines how psychological influences impact financial decision-making, has provided crucial insights into why investors, both amateur and professional, often act irrationally. One of the most powerful emotional biases is loss aversion, the tendency to fear losses more than value equivalent gains. Studies show that the pain of losing money is psychologically twice as powerful as the pleasure of gaining the same amount. This leads many investors to sell off winning assets too quickly to lock in profits while holding on to losing assets in the hope that they'll rebound. A real-world example of this can be seen during stock market corrections or crashes. When markets decline, investors often panic and sell their holdings at a loss, fearing further drops. But this emotional reaction often causes them to miss out on market recoveries, costing them potential gains. Herding behavior occurs when investors follow the actions of a larger group, often based on social proof rather than sound analysis. This phenomenon was on full display during the dot-com bubble of the late 1990s, when investors piled into tech stocks because everyone else was doing it. When the bubble burst in 2000, many of these intelligent investors saw their wealth evaporate. Financial education and literacy, the foundation for smart decisions. While intelligence is valuable, financial education and literacy are arguably more important for successful investing. A lack of financial education can lead even the smartest investors to make uninformed decisions, often influenced by emotions or trends. A key aspect of financial literacy is understanding the tools and products available to investors. For example, many individuals invest in mutual funds, ETFs, or individual stocks without fully understanding their risk profiles, fees, or the underlying assets. As a result, they may choose investments that don't align with their risk tolerance or financial goals. Additionally, complex financial products, such as derivatives or options, often tempt investors with the promise of outsized gains. However, these products can carry significant risks that even experienced investors may not fully appreciate without a strong foundation in financial literacy. Lessons from Warren Buffett and value investing. Few names in the investing world are as respected as Warren Buffett. Known as the Oracle of Omaha, Buffett's investment philosophy of value investing, buying stocks that are undervalued based on their intrinsic worth, has made him one of the richest people in the world. However, even Buffett has made mistakes, which offer valuable lessons for other investors. Buffett's missteps. Buffett famously avoided investing in technology stocks during the late 1990s, missing out on the explosive growth of companies like Microsoft and Amazon. While this decision may seem like a mistake in hindsight, it was consistent with his value investing principles, as he felt he didn't fully understand how these companies would generate long-term profits. However, Buffett's decision to hold on to certain businesses, like IBM, for too long resulted in underperformance. In 2011, Buffett invested billions in IBM, but he ultimately sold most of his stake in 2017 after the company struggled to keep up with technological advancements. This demonstrates that even seasoned investors can make decisions based on loyalty to their investment philosophy, sometimes at the expense of performance. The lesson here is that no investor, no matter how successful, is immune to making mistakes. The key is to stick to a disciplined investment strategy, while being open to adjusting it based on new information. Buffett's overall success lies in his ability to minimize his mistakes over time and consistently apply his value investing principles. Risk management and financial planning. Effective risk management is essential for avoiding devastating financial losses. A well-structured financial plan takes into account both the potential for growth and the need to protect against downside risks. One of the most effective risk management strategies is diversification. By spreading investments across different asset classes, sectors, and geographical regions, investors can reduce the impact of a poor-performing investment on their overall portfolio. For example, during the 2008 financial crisis, investors who had diversified portfolios that included bonds or commodities fared better than those heavily invested in equities alone. While diversification doesn't guarantee against losses, it does provide a buffer against extreme volatility in any single asset class. Having a solid financial plan is crucial for long-term success. This includes setting clear financial goals, understanding one's risk tolerance, and regularly reviewing and adjusting the plan as needed. For example, an investor approaching retirement will likely shift from a more aggressive, growth-oriented portfolio to one that prioritizes income and capital preservation, achieving financial independence through wealth management. The ultimate goal of investing for many is to achieve financial independence, the ability to live comfortably without relying on employment income. However, this requires more than just smart investing. It also involves sound wealth management and financial discipline. While some investors prefer to manage their portfolios on their own, others benefit from working with financial advisors. A good financial advisor can provide objective advice, help mitigate emotional decision-making, and offer strategies for growing and protecting wealth over time. A key component of wealth management is ongoing financial education. Investors who continuously improve their knowledge of markets, investment vehicles, and economic trends are better positioned to make informed decisions and avoid common mistakes. In conclusion, even smart investors are prone to making mistakes, often due to emotional biases, overconfidence, or a lack of financial literacy. The myth that intelligence alone guarantees success in investing is just that, a myth. The reality is that success in investing requires a combination of knowledge, discipline, and emotional control. By recognizing common pitfalls such as loss aversion, herding behavior, and overconfidence, investors can take steps to guard against these errors. Prioritizing financial education and literacy, learning from successful investors like Warren Buffett, and implementing sound risk management strategies can also help investors navigate the complexities of the market. The path to financial independence isn't without challenges, but by focusing on financial planning, wealth management, and continual learning, investors can achieve long-term success.